So, good evening once again. My name is Yogesh. Thank you so much for joining this session. Today's session is on trading during the earning season. To understand how important the earning season is, I welcome all of you. And if you can hear me, if you can see my presentation, please use your chat option and write a yes or a okay. So, just I can ensure that everybody can hear me properly, everybody can see my screen. It's really important for me to share some content, and I think I wish that everybody can see this. So if you can hear me clearly, if you can see my presentation, just write a yes or a okay. Perfect. Great. So, okay, I think most of you can see this properly. So just in case if there's a network congestion or uh, you know get signed out or you have to leave, don't worry about it because we continue to record these sessions and put it on YouTube so you can revisit these later, right? Although I would suggest you please keep a notepad with you in case if you find something really important which you can note it down, will really help you. We do these live sessions particularly for understanding what's going on with the markets. Financial markets are really volatile and there is a lot of risk. So today we are going to talk about how to interpret the earning season, what earning season actually is, how does it impact stocks. I'll also share the live trading platform with you to show that how the earnings have impacted before the previous quarter and what is the expectation now. We'll discuss a bit about what's going on right now in the financial markets. All of this, but please understand whatever things we are going to discuss, whatever strategies we are going to discuss, there is a lot of risk which still prevails. So basically, to understand that every strategy or any strategy we talk, it is not risk free. There is no assurance or guarantee that this is how you're going to make money, right? So please understand, as a responsible investor, you have to make sure that whatever you see outside in these webinars or seminars, anywhere, please talk to your financial consultants first, talk to your risk managers first before you apply any strategy, right? My job here is to give you as much information as I can and give you an awareness of what's going on. And of course, since the chat option is already there, please ask all the questions, whatever questions you have. I'll try to answer it right when we are in the session, or once I finish the session, try to answer these questions as well. And please feel free to write whatever doubts you have. Now, just a small brief of what's going on these days. And before we come to the earnings season, I'm sure a lot of you have seen markets moving. Uh, let's talk about October first. This month of October, I'm not sure how many of you have heard this, but there is something called the October effect. Okay. And the idea is that the stock market normally during October we have seen declining. Uh, just to make you understand, some of the biggest stock market crashes have occurred in October in the past. Again, guys, historical what has happened doesn't mean that it's going to happen in the future. But this is something which is a really interesting understanding because market runs on a lot of sentiments. There is logic, there is valuation, but there is investor sentiment also. And sometimes things are away from the logic. So I'm just keeping you aware of what something people can talk about. Uh, October effect is mostly seen when the stock market normally tends to decline, and some of the biggest stock market crashes they have occurred in October. Um, there was a bank panic. If you go back to 1907, the stock market crash happened in 1929, the Great Depression, which was also in October. Black Monday in 1987 also happened in October. So this is about the crashes. If you see on a broader perspective, S&P 500 most of the time in the month of October, most of the time has delivered positive returns. S&P 500 is a US stock market index. And if you see in last 10 years, I'll just give you a raw data. In last 10 years, at least 6 times in the month of October, S&P 500 has shown positive results. Again, It is never certain whether the market will pull back this month, but then investors, they should always have a game plan just in case if something happens, right? Because at the time of crash, there are so many sectors they perform badly. There are some sectors like, or talk about consumer staples or healthcares or utilities, they somehow are better than sectors like technology, right? Or biotech. So most of the time we have seen that during crashes, there are a lot of sectors they perform bad, but then few sectors which work really well, I mean better than the ones who perform bad, are consumer defensive sectors, utility sectors, something which you really need. Like take an example, if there's a recession, you might not buy an expensive watch, but you're still going to buy your toothpaste, right? So that toothpaste comes into consumer defensive sectors like utilities, consumer staples, something like that. There is also an energy crisis going on. So economic reopening is a very positive news for energy companies. We all know what's going on right now. If you look at the European industrial data, there is some problem going on in European industries, and we have seen European stocks going down a bit. So this is something which is going on right now, especially with stock markets. If we talk about oil, it appears to be very unstoppable. And like if I had to describe oil prices at this moment, I would definitely say that looks like very unstoppable because the rally has come into the picture now. And if you see the oil benchmarks also, they have definitely gone up in last 10 sessions. If you see uh, OPEC decision which has happened, markets are majorly looking forward in a bullish area. And one of the very important news which is coming out from China is the expectation of a very harsh winter, and there is a lot of power crunch. I mean, two-thirds of China's provinces have started introducing power rationing schemes since September, right? Now, because of this particular reason, now this particular move, it might affect the overall industrial output, okay? And it might add more and more pressure on the oil supply, with like it's already in shortage and might add more pressure. So it has already gone 7 years high. Next target from the analyst is at least $100. And now we are looking at oil inventories also. We are looking at daily oil movements as well, right? So within commodities, this is something which is from the gold side. Please, as I said, we'll talk about earnings also, but I'm just giving you a gist of what's going on. I'm sure a lot of you want to know what's going on with the current market. So I'm just explaining you what's going on with stocks, what has happened with oil. Um, Cryptos. I mean, how many of you, let's make this a little more interesting. How many of you have actually bought cryptos or invested in cryptos or are trading in cryptos? Just like write it on the chat. I just want to see how many of you are doing it, basically. I think, again, there's a big disclaimer which I have to give about cryptos, but then I just want to know how many of you are into. How many of you have bought Bitcoin or any other cryptocurrency in the past, or you are holding it now, or you have done this before? Okay, okay. See a lot of people here. Okay, some of you have invested in Cardano. Okay, okay. Dogecoin. Yeah, a lot of people invest in Dogecoin also. Um, okay, okay, okay. There's one question. Most of the stocks after COVID have skyrocketed. Now they're either consolidating or correcting. So what level should we now, as should we consider the spike the stocks had after COVID? Okay, definitely good question. Answer that. Okay, Bitcoin. Okay, so a lot of you have invested in crypto. So there's a question also. There's a question that most of the stocks after the COVID have skyrocketed, and now either they are consolidating or correcting. So what level should we now enter? I'm assuming as should we consider the spike the stocks had after COVID? So okay, let me tell you what's going on with the cryptos right now, and then we'll move on to the answer as well. Just giving you the updates. Bitcoin has broken above $50,000, something which again the level has been tested most of the times. The breakout has taken the crypto to its a monthly high. Bulls are really looking to retest again. The next resistance is $53,000. So I'm sure a lot of traders would be eyeing at that level. If $53,000 gets broken, then it might go higher. So if you see technically, their moving averages are the Bitcoin price is above its 50-day moving average and looks like on the higher side. Similarly, if we look at again stocks, we have seen equity markets falling down. Whether we look at Europe and Asia, mostly Europe and Asia in the morning. Even if you look at US also, we saw global markets actually falling down in last few sessions. Uh, some of the important news which came, New Zealand Central Bank has decided to raise the interest rates by 25 basis points. Now, when pandemic happened, a lot of central banks reduced their rates, and after that, not many of them increased it. So, in that, first is now New Zealand, which has made the decision to raise the official rate by 25 basis points. That's important. Crude oil prices are all-time high, like very much trading near high, as I said, 7 years high. So there's a lot of concern for the inflation, right? That is the one of the most important thing, that inflation is increasing. uh, the New Zealand's Reserve Bank, they have decided to raise interest rates. It is the symbol that which shows that central banks are not really concerned about the pandemic anymore, but they are mostly concerned about inflation. Because if inflation is increasing, that means things are getting expensive, which means demand is too high, which means people have too much money in their pockets and there's a lot of demand, and they don't want inflation to go too high also, right? Inflation is something which, if too high or too low, it's always bad. So it needs to be balanced. So now central banks are not really concerned about that pandemic is there, we should keep the rates lower. They are more concerned about the inflation, and that's why New Zealand's Reserve Bank has decided to increase the rates. So now this entire shift in the monetary policy, it is coming at a time which may not be really favorable also, because the economic growth all over the world has again started showing signs of slowdown. Okay. So this is something which is really need to be seen as a warning. And that's why all of you need to be very careful and understand that how much money you need to invest into stocks and how you need to do it. Because in the near term, in the short term, the stocks are going to face perhaps a lot of headwinds. Okay. And this is something with central bank withdrawing the whole stimulus part and tapering it, and economic growth slowing down, and oil prices going up and inflation coming in. So this is something which can backfire. And that's why the question which was asked, that what should be done with the stocks right now, I would suggest uh, be more inclined towards the consumer defensive sector, the utility sector. Mostly look towards the dividend stocks. Technology stocks, I feel that we need to be slightly away from. It's not something which we should be too much exposed to our portfolio, because when the markets fall, the first sector to get corrected is technology, and it's really volatile. So I would still feel that utility sector, consumer defensive sector is good to be a part of, because the volatility is less and some of these companies give really good dividends. Now, coming to the question, also the second part, when we looked at the pandemic, uh, a lot of those stocks, they did skyrocket. And a bigger part of that was that after the pandemic, when vaccine rolled out happened, it kind of just recovered from there. And the new high was mostly seen in the tech stocks and the healthcare stocks. Now, at this moment, if you still see what's the danger right now, the hospitality sector, the airline sector, even after the rules have become lenient, and we have seen vaccine rollout happening, those sectors are still not in the same profitability as they were before. So whether you look at airlines or hospitality, there is still a lot of danger. So we are going to talk about that in this earnings also. So we have to understand that what is earnings and what's going on, and how to interpret this. Please continue to write the questions as well. What earnings actually is? So earnings season, what actually earnings season is? So earnings season is basically is that time, every quarter it comes, is that particular time most of the publicly traded companies, they report their quarterly earnings, sometimes their annually earnings also. And this is when the stocks are at its highest volatility. You will never see a stock moving so much up and down especially what you will see during the earning season. And earning season happens every quarter. So you need to understand, because earning season can affect your investments really. Okay. Now in US specifically, when we are talking a lot about US stocks, in US earning season happens every quarter. So that is every 3 months for most of the public companies. Okay. Public companies means any company which is listed in the stock market here. In foreign markets, sometimes it happens every 6 months, right? So every 6 months, you have to see the earnings of the company. But in US companies, it's mostly 3 months. Uh, Now, the season generally begins a few weeks after the end of the quarter. So let's say July, August, September, 3 months ended, October started. Now, let this week go. You will see in the mid of October, the earnings of major stocks will start coming. So that is why we are doing this particular session today about earning season and understanding it, because October has just started. And if you understand how to trade during the earning season, how to invest during the earning season, you have the next 1 2 months where you can take advantage of the stocks volatility, right? Needless to say, there will be a risk, but then let's talk about that, right? So this is what earning season is. There are some companies, they get their earnings together and the report also right away in the first few weeks. Others, they wait for it, right? Now, if you have to point it out that when actually this happens, so just note these dates down in your notepad. I feel that this can help you out in actually trading during those times. The first quarter, uh, so Jan, Feb, March, I think, yeah. So by the end of the March quarter ends, so consider the earnings starts from April 15 and it will last till 31st of May. So for 1.5 months, you can try April 15 to May 31st. That's the first quarter. Okay. I hope everybody's writing it down. This is something which is really important. Not that you will not find it anywhere, but this is like really quick information. You can just use this. Now, after that, April, May, you will see a lot of volatility in stocks, a lot of stocks coming up with their earnings. Then comes the second quarter, which, so April, May, June, second quarter ends. So July 15 to August 31, you will see second quarter earnings. So April 15 to May 31st, July 15 to August 31st, then October 15 to November 30th, and then January 15th to February 28th. Every time a quarter ends, the next month, in the middle of the next month, the earning season starts and it lasts till the end of the next month. Now, your question, somebody asked a question that why it is so important to look at the earnings, how does it affect our investments? So here's the thing. Why it is important is because for smaller, like the companies which are growth oriented, earning is really, really important for them, right? Imagine some companies probably which your parents and grandparents have owned for 60 years, right? The companies which have existed for 50, 60 years, they have continued to grow. So they do not get really excited because they have grown in last 50, 60 years. Imagine companies like Coca-Cola or companies like, say, General Motors or General Electrics, like companies which are really, really old. They don't get excited about, they don't become too much volatile during this. But those companies which are smaller companies which are growth oriented, the Amazons, the Netflixes, the Teslas, the Zooms, these kind of companies, and then companies with a smaller market value, they are the ones who move a lot. So for growth companies, the reason earning is so important, the season is so important, because these companies are still in the process of providing out a business model and even their product also. So when quarterly earnings gets reported, let's say a few times in a year, and the progress is just, there are analysts, there are investors, there is a lot of media which is just waiting for these companies to come up with the earnings, right? And wherever there is media attention, you will see a lot of volatility happening. So it is all about expectations. Whatever the market expect, if the company delivers it on expectations, if better than expectation, stock goes up. If lower than expectation, mostly the stock goes down. And that's how the entire quarter plays out. So this is something which you have really need to pay attention. We are going to look at a few live examples also. I'll share my screen with you and I'll show you how this works. Now, first thing is we have to understand how to read the earnings report. It's public and it comes out. What an earning report is, it's a kind of document the public companies are legally required to produce every year. And there is a 10K report. And what is in the 10K report? So this is just a sample of a earnings report. Now, not that you have to sit on your system and read this because that's not your job. So I'm going to make it simplify for you. What you see right now in this is a few pages, sections where there are financial statements, there is financial resources and liquidity, what are the risk factors, what the financial statement is, how many sectors companies involved into. Now, few things which you need to read in the company's report or you should always understand before you buy a stock during the earning season is income statement, really important, the total revenue, the cost, the gross margin, operating expenses, net income, earning per share. I'll explain each and every segment in a very easily simple manner. And this is not something, again, guys, you're not a financial analyst, so you don't have to take time out of your job and sit and read financial statements. This is me just telling you that which are the important segments in an earnings report, right? So in case if you sit and you want to do it yourself, you can, right? There is always a consultant to help you out. So always keep a consultant for the second opinion. That's what I feel. Because at the end of the day, there is expert for everything. But unless you really just get into it and try to understand that what we are talking about, because I may be talking about, I should have just started with the earnings season directly, but I gave you an overview of what market is and how it's going on right now just to give you a certain picture that you can connect it to. Okay. I started with the October effect. I told you most of the crashes have happened in October, but at the same time, in last 10 years, 6 times S&P has given positive returns in October. So this is something which is a kind of base you need to know. Now let's start what an income statement is. Really easy to understand. We're talking about an income statement. There are three things which are really important: revenue, expense, and profits. Right? So it basically tells you how much money company has made in a certain amount of period. You calculate the total revenue, which is already provided. You see the total expenses, and then what is the profit? Is there a profit or a loss? You compare that with the previous quarter income statement, and you compare the same quarter previous year. So today, if I'm talking about Q2 2020, oh sorry, Q3 2021, then I can compare these results with Q3 2020 and then Q3 2019. So basically, every quarter can be compared to previous quarter, same year, and previous quarter a year before that, right? It gives you an idea of how the company has grown positively or negatively and helps you take an investment decision. That's your income statement. It looks something like this, not that you have to make it yourself. This is something how it looks. The total income, the changes, the adjustments, and then comes total revenue. Uh, if you made 100,000 units of something, you sold it for $10 at the market price, your revenue is 1 million. Exactly what total revenue is. Now, what important here it is that you should also see when you are looking at a segment in a company, sorry, uh, different segments from the revenues coming from. So, for example, Amazon has it's not just a e-commerce company. Amazon has Amazon Web Services, which is cloud computing. It has video streaming, which is Amazon Prime. It has e-commerce delivery, right? So when the revenue starts coming from a specific segment, you have to see, like for example, 15% of Amazon's total revenue comes from Amazon Web Services, which is the cloud computing segment. Now that's really good because cloud computing is increasing, and if Amazon has started generating more and more revenue in that segment, which means Amazon, which is an e-commerce company, now also has a good segment for cloud computing that makes company really big and profitable, right? If it continues. So that is something which is really good. What you're seeing right now on the slide, it is Apple's total revenue. And look at the segmented revenue comes from iPhone, iPad, Mac, App Store, other products like iWatch, AirPods. So this is again if you see, this is from 2018, but then this is how you compare revenue, the same quarter revenue with the previous quarter, and then the same quarter revenue with the same quarter but previous year. So if today Apple earnings come, or Apple total revenue for 2021 Q3 is say $100 billion, I would compare that Q2 2021 how much it was, and then Q3 2020 how much it was. So this is something which you should really understand, because you have to benchmark, you have to see, you have to compare and find out whether the performance is good or bad, right? Next, so this is how total revenue looks like. Then there is cost. Now, cost of goods, you understood income statement. What is the income statement? Total uh, total expenses minus the revenue. So total revenue minus any expenses is income statement. So total revenue, whatever the number of units produced, multiply the market price, the total revenue, and you need to compare the total revenue from the previous quarter, same year, and the same quarter previous year. So that makes an understanding that how it has gone up or down. And then comes the cost, right? How much cost was there to produce the goods? So if Apple only sold computers in the previous example, this would be the cost to manufacture, cost of packaging, and anything which is involved into purchase or into manufacturing of computers. So cost is something which is also important. Then comes the gross margin. So whatever are the net sales, you minus the cost and you divide it by net sales, and that's where the gross margins comes in, right? So the gross margin doesn't include all other expenses, and it's not a true picture of the company's actual margin, but it's a great high level data point to understand how wide their margins are. If the gross margins are shrinking, that may be a cause for concern. Then there is operating expenses. So operating expenses a lot of times include R&D expenses. So operating expense is something which is really, again, it is important because it includes the cost of research and development. Now, for tech companies and for healthcare companies, this is something which is really important because it adds to the overall cost of the running of the business, and it is something which is really significant for them. It does reduce the profit margins also, because our higher operating expenses, it will reduce the profit margin and can be extremely difficult to determine the story behind the numbers just by looking at it. What does it mean? It means that if there is a healthcare company which is doing a lot of research on Alzheimer's drug, right? If they reduce down their operating expenses in terms of research and development, if they reduce their expenses, which means that it may or may not be a good news. We cannot just say if operating expense, if research and development expenses of a pharmaceutical company has gone up, it doesn't necessarily mean that it's running in a loss. It might mean that they're spending more money on R&D, and they might be able to come up with a product which is, creates a monopoly in the market. Like Biogen uh, got an approval for a drug from FDA, which helps in Alzheimer. So this is something which again is a very subjective cost, and that's why you need to sit with your consultant to understand that if you're looking at the operating expenses of a company, and if it has increased, does it make that stock good or bad? Because it will depend on what industry and what sector the company is from. Followed by, this is how something operating expenses would look like: R&D, selling, general expenses, total operating expenses. Then the net income, the total revenue minus the total expenses, is where the net income is. Most of the time, companies come up with that there is an amount which you have to pay to the shareholders, you have to invest in any projects, pay off your debts, use it, keep it as a free cash flow. So that is your net income. Next is earning per share. Most important thing. Please write this down. So when earnings come out, what do you have to see? I mean, these are some important things, right? The most important things are uh, we saw net income, we talked about total revenue. But firsthand, when you look at the earnings report which comes out, Most important thing you have to see is EPS, which is called earning per share. Higher the company's earning per share, more profitable it is to be considered. Now, earning per share also needs to be compared. So if earning per share Q3 2021 is 20 cents, you compare the earning per share Q2 2021, whether it has gone up or down, and then you compare the earning per share Q3 2020. So previous quarter, same year, same quarter, previous year. Both the comparisons need to be done to understand whether the earnings have, because if so, let me show you this example how easy it is to do it. I'm just going to share my screen here. Chrome tab, and okay, this is a live platform right here. I'll open another one to tell you about how, okay, NASDAQ earnings calendar. There. Okay, I'm going to share it once again. Okay, now look at this. I'm sharing you, all I did was I Google searched NASDAQ earnings calendar. Okay. Now I'm going to click here on this. When I click on it, see this. Now look at this. August, October 6th. It's today. Okay, October 6th, right here. Now they say here, ending quarter is August 2021, right here. Consensus or EPS forecast. What is the forecast? 2.83. $1. So earning per share, what is the expectation forecast? It's already mentioned. So when the earning report comes out, it shows you how much it was last year. What is the forecast right now? So when the actual number comes in, you'll be able to compare with it. And look at this. So I'm just clicking on a random stock. Okay. See, all data is already there. Look at this. May 2021 earning per share was, guys, this is really important. I don't want you to lose interest on it. That's why I'm showing it to you. Just look at this number and I'll tell you how important it is and how easy it is, first of all. Now, what you're looking at right now is, don't see anything else, just see what I'm showing it to you. May 2021, the earnings of this stock, earning per share was 2.33. Earning per share is the whatever is the net income, you divide that income by the total number of shareholders. So basically, just to understand that how well your money in a company is being utilized. Okay, it's not something which you will get from the company. Okay, please make sure that there's a difference between earning per share and a dividend. Dividend is what you receive from the company. Earning per share is what is the earning of the company on the money which you have given to them, right? So it shows how efficiently your capital is being utilized. Now, the earning per share of this company, May 2021, start with August 2020, it was 2.76. Then November, it became 3.09. Then February, it declined. February 2021, it declined 1.82. Why it declined 1.82? Because 2020, November 2020, again, there was a pandemic issue and everything. So you see the difference in the earnings. And then May 2021, it went up to 2.33. Why? Because vaccine rollout happened and then market started getting better. So now there's an increase in the earnings. So this is how normally you keep a check on how the earnings have been previous quarters, and then same quarter previous year, how much it was. It helps you identify whether it the stock is consistent or not, right? And the markets also are looking at the same numbers only. Perfect. Okay. Let me go back to, yeah. So net income minus any dividend divided by the outstanding. Higher the company's earning per share, more profitable it is considered. So you have to see the earning per share. Then the PE ratio. Now PE ratio is something what we call as a price earnings ratio. Just to understand is, it kind of tells you that whether the company is trading at an overvalued price or at an undervalued price. So just to understand whether a company, so whatever is the stock price of the company and whatever is the earnings of the company. So if you compare the earnings of the company, how many multiple times of the earnings the stock is valued in its market. So sometimes there are companies which are earning X amount, but their PE ratio is 10 times their earnings, which means the stock is priced 10 times more than their earnings. That particular 10 times, that premium is paid by the market because of the certain reason. Maybe the company is really good, right? Or sometimes when we don't see any justification, like go back in 1960s. What was going on in 1960s? Any company which attached the name Tronic by the end of their name uh, became uh, successful in terms of in the share market. The investors, they started buying companies because they were so excited about the future technology that any company with the name Tronics would be bought in the market left, right, and center. So that time there was so much inflated prices. It became again, these are so many stock bubbles we study. So this was one of the 60s bubble where a company was trading 100 multiples of its earnings, and that premium that time was justified because it was, everybody thought that it's a tronic company, it's an electronic company, and it's going to be the future, right? Later on you will see that in the next 2 years that companies went down completely and disappeared and bankrupted, right? So even 100 multiple times the earnings, that premium, if it is not justified, that's why a lot of analysts, they look at the PE ratio of a company and they compare it with their competitors, and then they compare it with that particular sector. So if you're looking at the PE ratio of Amazon, you cannot compare the Amazon PE ratio with Pepsi. You will compare Amazon's PE ratio with Alibaba. You will compare Amazon's PE ratio with a company in the e-commerce sector, right? That's how you compare whether the stocks are overvalued or undervalued. Something which really helps you out. Again, guys, let me tell you this thing. There are consultants already which they do this for you, okay? So me talking about this session is not about that you have to sit and do it yourself. There are people who can do this for you. All I'm saying is this is one of those awareness session which actually tells you that uh, which are the important things, and you should be in command. You should know what happens with your portfolio and why a decision is taken when it is taken. Then now comes to the point how to interpret the earning season. So now you have seen all these important points. You saw the earnings, you saw earning per share, right? Now you talked about total revenue. So total revenue, earning per share, and P ratio, and the net income, for example, and operating expenses. So how to interpret the earning season? Look at three things. Okay. Write this down, click a picture if you want to. EPS, which is earning per share, revenue, and forward outlook. EPS is earning per share. So when a stock earning comes out, you have to clearly check their earning per share, how much it is. And then you have to compare that earning per share with how much market expected. Okay. Let me give you a very good example. Okay. I'm going to share my live platform with you now. Okay. These are live prices. This is the platform. All you have to search, let's say, DocuSign. So DocuSign is a company which helps the anyone who's using DocuSign is using it for the purpose of forwarding a document online to someone for a signature. We did that. We did a lot in this in the pandemic, and the stock is priced to $61 per share. Now, let me show you here. June, July. So look at this. I told you it comes every quarter, right? Between 15th and then the other month, 30th. So when the quarter ended here, 30th March, I hope everybody can see uh, this. So this is the date right here. I'm gonna open my cursor. Look at this, 30th March, and the price was 197. How I can see it? You need to look at this right corner here, which shows the price, and then this horizontal shows the date. Now, 30th March, look at the right side. The price was around $202. March. Then comes the earnings season. Now, look what happened here. April. Now, this is probably where the earnings came bad. And now look at the stock. From 231 went down all the way to 180, and then probably again started recovering in June. So basically, what we need to understand is the volatility which comes during the earning season in a stock is of prime importance. If you have a portfolio, it will probably see a rise or a fall. But you as an investor have to understand that the earnings come every quarter. So if one quarter the stock has bad earnings, doesn't mean that it's a bad stock. This is a really important thing. Uh, if earnings for one quarter is bad, it doesn't mean that the stock is bad. Every company, Apple, Facebook, Microsoft, Tesla, they have given a lot of times bad earnings in their quarters due to a lot of reasons. Like in pandemics, every company had a bad earning. But what we need to understand is the correct reason behind it, by how much percentage the company has missed the benchmark, and what is the future outlook. This is really important. So I'll give you one example. Every time Tesla in the first 15 years of Tesla as a company, there were every year 4 quarters. Yeah. Every year 4 quarters. That means around 60 quarters of earnings. And Tesla showed profits in just 8 of them. Yet the stock price continued to go high. Why? Because every time they used to come up with bad earnings, Elon Musk used to talk about the brilliant future of Tesla and what it is doing, and investors used to buy it. Eventually, the stock became what it became. But all I'm trying to say is that it's not necessary that if one quarter is bad, you should take the stock out of your portfolio, right? You have to see the overall uh, forward outlook also. So that is one thing. Let me show you once again. Here, EPS, revenue. So earning per share, revenue. And what is forward outlook? Forward outlook means that what is the expectation of the next quarter from the company. So this quarter, okay, you gave a bad result. What about the next quarter? What are you going to talk about? And it's not like that if a company has delivered bad results now, they are just going to say, "Oh, we are going to do great in next quarter." I mean, if unless they are really sure of that. Like Apple, a lot of times they declared really good results this quarter, but they gave a forward outlook that next quarter it doesn't look that brilliant because of the shortage of the semiconductors in the market. We are not able to manufacture as much as we did in the previous quarter. News spread, stock came down in spite of good earnings, right? Why? Because the further future outlook for the next quarter is not good. So all these three things, earning per share, revenue, and forward outlook, is really important. The impact of earnings season, I just showed you on the stock how it works. Let me take you further to different stocks, right? Let's see different stocks. Why just stick to one? Let me show you. Okay, guys, give me the name of the companies. Try specifically US. Any company you want me to open the chart and show you how earnings have how the earnings season has impacted. Just give me the name of any company. The ones which you like, the ones which you don't like, could be anything. Go ahead. Okay, I'm getting a lot of names here. I'll pick a few. I'll pick a few. I'll open a few charts. So go for it, whichever you like. Mm-hmm. Okay. 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 A lot of usual ones here. Okay. Right. Right. Okay. Perfect. Okay. Great. So, okay, there are a lot of names, different kind of name. I'll pick some of them. These are mostly famous ones also. So let me share this here. Okay. Check Netflix. Right. going to take the same period, right? Look at this. So March ending here. This is the March 26th, 30th, right here. It was around $516, right? And then see, this is between April. So I think 21st April, that's where the earnings would have come. And there's a big gap from $550, it came down to 513, went down, and then eventually again started going higher. Now came, so this is April, May, and then June, 3 months of stock. And then July came, the earning season again started, and that's where you see stock going higher for the July, August, September, right here. So basically, the idea is any stock. Look at McDonald's, for example, something as common as McDonald's. Look at April. Again, we're showing you first quarter, April. So February, March, where's March? This is where March ended, right? 24, 20, and 30th March. From 30th March, again, see April, May, it went, continues, goes up to 35, comes down to 28, and then again July, next earning season 246, and then again now October. So a lot of such companies they get impacted during the earning season. That is the impact of the earning season. Now, a really important point for which we gathered here, we'll take an outlook. Again, this is one of the examples what happened with MNC Sachi. After the earnings result, the stock fell almost 50% due to the bad earnings. Okay, now comes the last segment of this where we'll understand that how to strategize, how to trade during the earnings season. So for those investors who do not like to trade or not like to take chances during the day trading, uh, you don't have to do it. This is just an informative session. If you feel like doing it, still talk to your risk consultants, talk to your financial consultants, and only then until you really understand these things. For those people who are long term, who want to do day trades during the earning season, price action analysis is one of the most used ways by analysts to trade during the earning season. Because if you sit here and just take a guess that I think Netflix has done really well and the earnings is going to be positive, and take a trade, then you're still doing a guesswork. I mean, that research is not backed by anything. Okay. Price action analysis is something which shows you that how the stock has moved after the earnings for the same quarter in last few different years, right? So this is again, guys, something really, really important. I think if there's a way I could, yeah, there's a way I can show this to you. Look at this. Just 1 second here. Yeah, good. I can show this to you. Perfect. What you're looking at is a price action analysis, okay, of Expedia and Tyson Food. Let's see Expedia first. Okay, let me move this a bit. Now, what we are looking at the analysis of, and I'm trying to be very simple over here. Let's understand what we are trying to see here. The price movement of Expedia as a company, the stock price movement of Expedia just after the earnings come for the next 1 day, next 2 days, that how it has moved. It's not about good earnings or bad earnings, okay? It is about how the stock has moved after the earnings at all. Now look at this. Let's take Expedia first. The earnings date, again, this is, guys, is not a recent flyer because earnings have not started yet. So we are not doing a price action analysis now, but we are going to do it soon in the next week. But this is from the previous quarter. Now look at Expedia. So what we did, it was second quarter 2021. So we did an analysis of the stock price movement of Expedia after the earnings of Q2 in last 10 years. So the earnings date was 6th August. Okay. If you enter one day before earning, hope everybody can see this. Yeah. If you enter one day before earnings, and when I say enter one day before earnings, which means if you buy Expedia company shares one day before the earning result and exit on the day after the earnings come, and if you had done that in the last 10 years, every time in the second quarter, what you would have experienced here? You would have experienced that most of the time. So in 2020, if you had done that, your portfolio would be down by 5%. 2016, it would be down by 2%. In 2013, it would be down by 27%. But at the same time, 2019 up by 1%, 2018 up by 10%, 2017 up by 3%. On an average, what we understood was that if you enter into Expedia stock position, you buy a day before earning and you exit on the day of earning after the earnings come out, you will see on an average 2.8% return as compared to last 10 years on an average, and the probability of gain in price is 70%. Maximum gain you could have seen was 20%. However, maximum drop is 27.4%. Similarly, scenario 2, if you enter on the day of earnings and hold on to 1 month after the earnings come, look at this. Horrible, right? The average return would be negative, and the probability of gain in price will just be 20%, which means instead of buying the stock, you should be short selling the stock. In these CFD platforms, you can short sell a stock where the price goes down and you make money out of it, right? So, again, now there's a question that is this not speculation? Yes, this is speculation. But somewhere, because you have access to the historical price movement, now your decision to speculate the stocks became slightly better than you just sitting and guessing what to do, right? So price action analysis is all about studying the historical trend of last 10 years, understanding, see, where the effort has put, where the research has put effort into it. They checked probabilities that if I entered a day before earnings and exit on the day of earnings, and if I had done that in last 10 years in quarter 2, what would be my probability of gain in price, or what would be my average gain? Which there are so many companies, imagine trading in them using price action analysis, right? It's a game of numbers, it's a game of probabilities and possibilities. But just blindly speculating and taking leverage does not help. So that's why you need a price action analysis strategy. This is again, guys, for short term traders, this is something which you can use, right? Or for day trades. For long term investors, this report will just serve as a confirmation, and that's all. Because a long term investor, I'm not going to ask you to trade daily because that's not your forte. What this strategy will do is just give you a confirmation that on how the stock price is expected to move. That's all. If you want to do day trade, again, use that strategy. But again, please talk to your risk consultants or talk to us and then only do it. So there's a question asked, what is short selling? Very good question, because the second column which you see here, where you enter into Expedia on 6th August and enter a month after, it shows that had you done this in last 10 years, most of the time you would be making a loss if you were buy on the stock. So to make sure that how to take advantage of the falling price, you do short selling. How short selling works, let me tell you. I have to use this bottle of water right here in the demonstration. Short selling means that when you are expecting the price of something to fall, okay, you borrow that commodity from your broker and sell in the live market. And when the price comes down, you buy it cheaper. Let's take example. Let's say this bottle of water currently costs, or let's say this is not a bottle of water. There is sanitizer in this. Okay. Now in 2020, the bottle of sanitizer, let's say this bottle of sanitizer was costing $100. Now, I was a visionary. I thought that, you know what, right now this sanitizer is $100. But after 1 year, when vaccine rollout happens, the same sanitizer bottle will not be sold for $100. It will come down definitely to 50. What I did, I thought I can make money over this. So what I did, I borrowed this bottle of sanitizer from Century Financial, which is the consultancy company here. But let's say I borrowed this bottle of sanitizer from the company here and I sold it to you here. This. I sold it to you. $100. I borrowed this from the broker and sold it to you. Now, when I borrow this from the broker, and when I say broker, that means any platform provider which you are using. In this case, it is CMC Markets. It can be any other broker. I borrowed this bottle from a broker and sold it to you for $100. Now I have $100 with me because I sold it to you. So you gave me $100. I keep it. What's the next thing? I waited for 1 year. And when the vaccine rolled out happened, the bottle of sanitizers now, not everybody needs this sanitizer with the same demands. There's no urgency. So the price fell. Price fell to $50. Now I borrowed this bottle from the broker and sold it to someone and I got $100. So the transaction is not complete yet because I have to give the bottle back. So what I did, I went to the market and I bought a bottle of sanitizer from my $100. But this time I did not pay 100 because now the market price is 50. So from the 100 I had, I paid 50, got back the bottle of sanitizer and gave it back to my broker. Now the transaction is complete. This is called short selling. You can do this in your platforms. Let me show you a live demonstration of what I'm telling you right now and how easy it is to do it. So I'm going to show you the live platform right here. So whenever you see that the stock is expected to go down, look at McDonald's, for example. All you have to do is click on this price, which is your selling price. See, this blue means buy and selling means short sell. Okay. So when you sell it, you write 100 shares in the quantity, press enter, 100 shares multiplied by price. So this $244 per share is McDonald's per share price, $244. So if I want to buy 100 shares, I have to give $24,000. Now, common question, how can you sell something which you don't have? How did I sell this bottle of water? By borrowing it from the broker. So similarly, when you're clicking on sell, you are borrowing it from the broker. Let me show you how. The moment you clicked on the sell and you put your quantity, automatically you are borrowing this from your broker. When you sell it, place the sell order. Now you have sold. Again, you sold it from the broker's inventory. Close this, go to your positions right here, and you can see that it says S, McDonald's. S means sell 100 shares at 244.09. Currently, you have a floating loss going on. It will move up and down. If it is in green, it's profit. If it is in red, it is in loss. But look at the price. You have sold at 244.09. The buying price is 244.16. So it is higher right now. If the buying price falls, that's where your profit starts. So what do you think? In the pandemic, not everybody was in the buying position. There are a lot of people who short sell it. So short selling is a legit concept. If you Google search short selling right now, you will get infographics, videos, and everything. Look at the portfolio. Now you're making a $1 profit. Look at the buying price immediately. What is the buying price? 244.08. 244.06. Look, now you have $3 profit. Why you have $3 profit? Because you sold at 244.09 and your buying price is 244.06. 3 cents price is down and you're making $3 because 3 cents multiplied by 100, you're making $3 profit. So the idea of short selling is that when you're expecting markets to fall down, you can short sell also. So this was again one of the question when it was asked that what should we do when the stocks have spiked up. So this is something what you can do. You can short sell it, but please be careful that if you short sell a stock, your loss is when the stock starts going higher, and there is no cap you can put on how high a stock can go. So please always have stop losses when you're doing it. See, now you have a $8 profit. How you have a $8 profit? Because now it is $12. Because you sold at 244.09 and now your buying price is 243.97. Look at the extreme right corner, it is mentioned, right? So this is how short selling works. You can close your profits, losses anytime you want on the direct platform. It becomes easier, right? So I hope this is clear that how short selling works and how the price action analysis work, right? So this is what price action analysis is, that you check the historical price movement and see whether historically, whenever the earnings have come, how the price has performed. Okay. So, guys, this is again one of those things which we do on week basis. So, if you liked my session, if you did not like my session, any feedback you want to give, please go ahead, review us on Google. We definitely thrive on these reviews. We want to continue these sessions. I do it every week on some of the different sessions. Next week, we are going to do on trading strategies, pair trading strategies, something which is very trader specific, but at the same time, a lot of investors are doing it right now. Uh, Strategies which are based on arbitrage. So please give us your reviews. If you like my session, please give us good stars. Please give us good reviews, and we make sure that we continue these kind of sessions and make the most out of this. So if you have any further questions, uh, there's one question: is there a demo account available? Definitely, you just need to call your relations manager, and they will give you a demo account, and we can always do this. What is margin and how to use it? Good question. Let me show you right here. Since the platform is open here. See, let's have a one-on-one session. I'll explain you more about margin, but since you're asking it here, I'll definitely tell you. See what margin basically is. Anything you buy in an online trading platform, you do not block your full money. So right now, the amount of McDonald's which I have put short sell it. Okay, let me give you a buying example to make things easier. Let's say I want to buy Tesla shares. Okay, this is Tesla. I click on buy. One share is $782. But when I go to product overview, it shows me that the margin rate of Tesla is 20%. 20% margin means that if I want to buy one share of Tesla, which is $782, I don't have to give 782. I just have to give 20% of 782, which is 156. Let's make it much more easy. If I want to buy $100,000 worth Tesla, so I write it in the amount. It's equal to 127 shares, depending on the price. Margin is 20%, which means I just have to give $20,000 to take this trade worth 100,000. I will have shares of Tesla worth 100,000 only, but I don't have to give $100,000. I just have to give $20,000 from my account value where I have already put 100,000. But all I have to give is $20,000. So see what happens when I do the transaction. I click here on buy. I place the order. I bought Tesla shares. Now see what shows here. Let me zoom this. See, from my $100,000, 20,000 is taken margin for Tesla. The 4,800 is the margin for McDonald's, right? I have a McDonald's position also. So every transaction you do it on margin basis. See, 20%, 20%. 20% of 24,000 was 4,800. This was taken. 20% of 100,000 for Tesla, it was 20,000. This was taken. Now, the question is, why use margin at all? Why can't I just give cash and have the stocks? Because these are derivatives, these are CFDs. CFD means these are the replica of the actual stocks. These are not the actual stocks which you own. A lot of investors, they buy and sell CFDs because it is easier to speculate transaction and you just have to block a percentage. Is it dangerous? Yes, if you overuse it and if you abuse it, right? Because if you have $100,000 and you keep booking 20% and take a position worth a million, tomorrow if that million position comes down by 10%, you lost your 100% capital, right? Because you were 10 times trading more to use margin. So that is there. Again, let's connect one-on-one and I'll explain you more that how margin actually works and how to safely trade. Another question, do we look at any fundamentals of the stock if you buy a stock for swing trading, max holding period 6 weeks? See, if you're talking about 6 weeks, it's not swing trading. Swing trading is much more, I know what the books definitely say, but okay, let's say on the charts basis, let's consider actually 6 weeks as swing trading. Uh, Basically, you don't have to look fundamentals if you're doing swing trading because what you're looking at is, let me show you here. It's again a very good question, guys. I hope everybody should see this. Let me show you the chart over here. Okay, let's say I actually want to show you a proper chart. Uh, okay, let me show you this way. It's better actually. Where's my platform? So I'll take McDonald's again since it's open. Can I open this chart? Let me zoom out a bit. See how a swing would occur. Let's say, let me reduce this interval to 4 hours. Okay, now swing trading would be something like this. So this is the price movement. Okay, I'll turn the whiteboard on and make it less transparent so I can use the marker and this way. So you would enter when you're taking swing positions, you want to capitalize the medium highs and lows basically. So sorry, where's the color? White and red. Something like still black. So here, here, red. See this point, this point, then this point, and this point, and basically you will estimate this point, but it went down further, and then this point. So swing trading is, as the name suggests, this, 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 this. You want to capitalize this movement and this movement. So your what you have to be careful is your entry and exit points. You should not be entering over here. Okay, should not be entering over here. Your entry point should be related to this, and it will be easier if you're drawing a trend line. It will be easier for you to identify the swing positions, but none of that has anything to do with fundamentals. Yes, if you look at fundamentals and if it is supporting your technicals, then it's not bad. But then you would not specifically look at fundamentals to identify whether it's a good swing or not. I mean, as long as it favors, because sometimes technically when you're looking at a chart, fundamentally it may not be supportive. Like right now, good that we are talking about this. Look at this example over here. Adidas. Okay, one of my clients actually asked me this question, so glad we are talking about this. Look at this. Now, Adidas is just looking at it's a perfect support line, right? Look at this. Like, why would anybody not be buying Adidas? Look at this. See, here, 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 and now it's here. Looks like a perfect support line. Everybody should buy it. But market trend is on such a downside that people are scared. Like one of my clients is actually scared to buy it, but he's like, it is at such a good support level. But fundamentally, markets are on the downside. Why fundamentally on the downside? Because central banks are expected to higher increase rates, inflation is increasing, so stocks are expected to go down. But this stock is at such a good support. So if you're following technicals, you would buy. But if you're following fundamentals, you would short sell. But if you want to mix technical and fundamentals, you will get confused because technically a very good level to buy because the past support lines have been perfect. It is a perfect time to buy. But when you see fundamentally, it should be a sell. So you have to pick your stand. That's why when you are talking about swings, also see this is also swing right here, right here, right here, right? You just have to follow technicals. If fundamentals support your technical call, then it's even better. But if it goes against it, then it's a problem. So it mostly has to do with the technicals and less with fundamentals. I hope this answers your question. If not, again, let's have a one-on-one session and try to understand more. I'm sure I have a lot of people in this company, but who are consultants, basically consulting clients, so they will have a different opinion. So if you want to do that, please come and talk to them as well. But this is normally what I feel that this is how it should be. It should be mostly based on technicals. And fundamentals could be just for second opinion if it supports in a positive way. That's all. Otherwise, it will just make you more confused. Right. So that's perfect. If you need any demo accounts, yes, perfectly. If you need demo accounts, you can talk to Adam. When you are available for a one-on-one session, I'm available for one-on-one. So I'm traveling actually tonight. Today is, yeah, it's 8 o'clock. I have my flight at 1:40, so I'll rush home and pack and leave by 9:30. So I'll be coming back next week, but I'm in India. I'm carrying my laptop. So if it is there, definitely. India has much nicer weather at this moment. So I'll be available to have a one on one session. So nothing to worry about. Let's have it. If you don't want to do it, we can definitely do it after a week. I'll be back and we can do this. How to open a live account? Opening live account is not a problem. I would still suggest you understand this, how it works, your risk management and everything. Opening an account takes 2 days once you submit the documents. The entire process is online, so nothing to worry about, right? Before I leave, on behalf of Century Financial, my team, my family, and myself, a big vote of thanks to anyone who is concerned with the healthcare industry, who is working in the healthcare industry, who have friends or family who are working in the healthcare industry, first responders, doctors, nurses, midwives, everyone who have contributed, um, have spent their fair share of time in treating COVID patients or otherwise are real heroes. So we owe so much to them, and I want to show my extreme support and convey a big word of thanks on behalf of everyone here in my company and in my family. I hope that you stay in good health and definitely in good wealth. So do not stop investing. There is a lot to come this earning season. Let's try to sit one on one and understand more how to approach this and how to lead successfully. My name is Yogesh. We'll be again meeting next week for a different session on trading strategies. Till then, uh, talk to us, reach us out, and we'll definitely help you in understanding these financial markets. The whole idea of this session is to make you more independent, but not to leave you alone. And that's what Century Financial stands for. Once again, my name is Yogesh. You have a great night. Please take care and take a very good care of yourself.